Okay, I know what you're thinking. That statement sounds incredibly dense, maybe a little bit pretentious, but stick with me, because that one sentence, it's the absolute blueprint for the entire global insurance industry. It tells us that the real business isn't about collecting your monthly payments. No, it's about mastering time itself. It's about taking a promise about the future and turning it into a real cash-generating asset today. In this explainer, we're going to tear that machine down to its parts.
So, here's how we're going to do it. First, we'll look at the core profit engine, this engine of asymmetry. Then, we'll check out the dashboard they use to fly this thing, the performance metrics. After that, we'll see how they navigate the economic storms of market cycles. We'll even decipher some of their secret language, the obscure jargon they use. And finally, we'll get to the big one, the two completely opposite ways of looking at what this industry even is.
All right, section 1, the engine of asymmetry. This is where we leave the simple idea of paying for protection behind and step into the world of high finance, a world where a debt, a liability, is actually the most valuable asset you can have.
See, the whole model, the entire business, it all comes down to one almost magical concept called float. An insurer takes your premium, and on their books, that's a liability, right? It's a promise they have to pay you back if something bad happens. But here's the trick. They perform a kind of financial alchemy. They transform that liability into a powerful, productive asset that works for them.
Let's really zero in on this definition, because it's everything. Float is this colossal ocean of money, we're talking trillions of dollars globally, that's been collected from everyone, but it's just sitting there, waiting for claims to come in. Now here is the crucial insight. The insurer doesn't actually own this money, it's not their revenue, but they have control over it, and they have the legal right to invest it and keep every last penny of profit it generates. This is the absolute heart of the machine. So if float is the engine, how do you know if it's running well? Well, you need a dashboard. And that's what these performance metrics are. They're the gauges and dials that tell the insurer, and anyone watching, just how healthy the company is. If you want to understand this industry, these are the numbers you have to know. So you're reading an insurer's annual report, and you see a number like this, 92%. What does that even mean? On the surface, it looks pretty good, sure, but its real meaning is so much more important than just being a high number. This 1% tells you almost everything you need to know about the company's core operational skill.
That 92% is what's known as the combined ratio, and it's actually made of two other numbers. First, you've got the loss ratio. Pretty simple. It's the chunk of premiums that get paid out in claims. The sweet spot is around 65 to 75%. Then you have the expense ratio. This is what it costs to keep the lights on, salaries, rent, marketing. You want to keep that around 20–25%. You add those two together, and the magic number, the absolute goal, is to stay below 100%. And here is the punchline. A combined ratio of 92% means that for every single dollar they brought in, they only spent 92 cents on claims and running the business. That means they made an 8% profit just from the act of selling insurance. This is called an underwriting profit. It's pure profit, and it's the holy grail of the industry. And remember, this is before they've earned a single dime from investing that giant pool of float.
Now we get to the fun part. They take that massive float and they put it to work. The performance of their investments is usually measured against something super stable, like 10-year government bonds, what finance people call the risk-free rate. But a really good insurer isn't happy just matching that. Their target is to beat it. They aim for a premium, a spread of 150 basis points, that's 1.5% on top of the risk-free rate. This is where that 8% underwriting profit gets turbocharged into something much, much bigger. But hold on, you can't just go wild with this investment strategy. There are rules. Regulators impose something called a Solvency Capital Requirement, or SCR. Think of it as a financial stress test. A ratio of 100% is the bare minimum. You dip below that, you're out of business. But nobody aims for the minimum. The real players operate way up here in the 180% comfort zone. That huge buffer isn't just about safety, it's a signal of immense financial strength to the entire market. It says, we can handle anything you throw at us. Okay, so we've got the engine, we've got the dashboard, but what about the world outside? An insurer's strategy has to change radically, depending on the economic weather. And that weather is defined by a constant back and forth between two totally different environments. And here they are, the two realities of the insurance world. On one side, you have a hard market. Think high inflation, soaring costs. It's a tough environment, but it gives insurers huge power over pricing. On the other side, a soft market.
Here, interest rates are on the floor, investment returns vanish, and the only way to survive is through brutal, surgical discipline.
Let's dig into a hard market. What kicks it off? Usually runaway inflation. Suddenly, the cost to fix a car or rebuild a house just explodes. The insurer's claims costs go through the roof. So what do? They flex. They use their pricing power to crank up premiums. We're talking aggressive hikes of 15% or more, and they got a lot pickier about who they'll even cover. In a hard market, profit comes directly from their ability to dictate terms.
A soft market is a completely different beast. The problem here is that interest rates are basically zero. That giant float we talked about, it's suddenly earning almost nothing. The investment engine has stalled. So profits can't come from the market anymore. They have to be squeezed, painfully, out of the operation itself. This means surgical underwriting, only ensuring the absolute safest risks, and cutting costs everywhere, usually with tech and automation. The game becomes about pure efficiency and dodging the nightmare of adverse selection, where only your worst, riskiest customers are left.
Now, before we go any further, we need to hit pause and learn a little of the language. To really get what's happening behind the curtain, you need to understand a few of these obscure but absolutely critical terms. Each one is a tool, a lever for managing risk and money.
First on the list is IBNR. It stands for Incurred But Not Reported. It's basically a highly educated guess. It's a reserve of money set aside for claims that have technically already happened, but nobody's filed the paperwork yet. But look closely at that last line on the slide. A key lever for the legal management of financial results. This is where it gets interesting. How an insurer calculates IBNR is part art, part science, and it has a direct and totally legal impact on the profits they report each quarter. It's a way to smooth out the bumps.
Next up, retrocession. This one sounds complicated, but the idea is simple. You know that insurers buy their own insurance, right? That's called reinsurance. Well, retrocession is the next level. It's when the reinsurer turns around and buys insurance to cover its own massive risks. It is literally the insurance for the insurer's insurer. This is how a single catastrophic risk gets sliced into 1,000 little pieces and spread all over the global financial system.
And what makes this all work financially? The ceding commission. When a regular insurance company cedes or hands off risk to a reinsurer, the reinsurer pays them a fee. This commission basically covers the original insurance costs for finding the customer and doing all the underwriting. It's the payment that keeps the entire risk transfer chain moving.
All right, let's pull back for our final section. We've seen the mechanics, the numbers, the strategies. Now we get to the philosophy, because all of this leads to a huge, fundamental debate about what an insurance company really is. Is it a brilliant financial engine, or is it a time bomb waiting to go off?
And here are the two sides of that debate. On the one hand, you have what you could call the Warren Buffett Thesis, that an insurance company is, quite simply, the best business structure ever invented for generating cheap capital to invest. And on the other hand, you have the Black Swan Thesis, that the entire industry is just picking up pennies in front of a steamroller that's getting closer every day.
Let's look at the capital arbitrage model first. It is just beautiful in its financial logic. Think about it. If your combined ratio is 98%, you have an underwriting profit of 2%. That means people are paying you 2 cents on the dollar for the privilege of giving you their money to hold. You have a float with a negative cost of capital. A normal bank has to pay you interest on your deposits. An insurer is being paid to borrow. It is an almost unbelievably powerful financial advantage.
But then there's the other side of the coin, the systemic risk model. And this argument is really sobering. It says that insurers are in the business of selling insurance against tail risk, those incredibly rare but civilization-altering disasters. And their steady, predictable profits aren't proof of their genius. They are simply the premiums being collected on a catastrophic Black Swan event, a truly global pandemic, a coordinated cyber attack that takes down the grid. That just hasn't happened, yet. But statistically, it will. And when it does, decades of profit could be erased overnight. And this chart really brings the Hall debate into focus. When you look at where the profits actually come from, it's startling. For a typical insurer, a tiny slice, maybe 10%, comes from that core business of underwriting. The other 90%, the vast majority, comes from investment income on the float. This visual makes a powerful case that the business isn't really insurance at all. It's an investment fund that has cleverly figured out how to get its capital for free, or even better than free.
And so that leaves us with this one final unsettling question. Is this entire industry a masterclass in managing capital, a pillar of our financial system that cleverly turns risk into reward? Or is it something far more fragile, a business model based on selling protection against a catastrophe that hasn't happened yet,
but one day, inevitably, will? The answer to that question really defines everything.